Hello, everybody. Look who's back. It's Ted Bauman here. And this time I'm speaking to you as an individual. That's right, I no longer work for Banyan Hill Publishing. I'll talk about that in a moment. But I am back on YouTube. Sorry it took me a little bit longer than I wanted to, but I decided to make a turn for Thanksgiving with some family. And so I have been away from Atlanta for the last week. I'm back now. I'm relaunching this YouTube channel under my own name. It's always been under my name, but previously I was employed by a company called Banyan Hill Publishing, as you know. I am no longer employed by that company, and I think that tells really something about what's been happening in the stock market this year and how people tend to react when the stock market is in a bad way. Let me explain what's happened, and I will then tell you what my plans are, what I'm likely to be doing going forward, and particularly how interested I am in hearing what you want me to address, what topics you want me to cover. I do have some interesting ideas. So let's talk about what's just happened. Well, the financial publishing industry, which is what I was part of, I had a newsletter called the Bauman Letter and some subsidiary products, has been in a bad way in 2022. It really started on the first day of trading this year. That was the peak of the market. It's been pretty much all downhill since then. Those of you who pay close attention to the market know that there have been a couple of false rebounds. We've seen one over the last couple of weeks. That's been nipped in the bud by news out of China this morning with all the popular rebellion against the Chinese Communist Party's no COVID policies. But those are all short-term things. I think eventually we're going to hit a market bottom, and that bottom is going to come when the Fed unambiguously signals that it is no longer going to be pushing interest rates up at the rate at which it has been up to now. In other words, back-to-back 0.75%, 75 basis points increases. Now, when that comes, I don't know. The prediction business, those of you who've been watching me since the early days will know, is something that tends to burn you. But I do predict that that's going to be the main driver. The war in in Ukraine is also going to be a key driver, particularly when it comes to energy prices, but I'll leave that aside for the moment. Let's talk about financial publishing, where I've just come from, what lessons you can learn from it. Now, in the financial publishing industry, the one I was just in, what we do basically, or did, is offer investment advice at a much lower cost than you would get if you paid a broker or if you paid somebody else to invest your money. Because simply, by paying, $49 or $79 a year, you get, monthly reports recommending new stocks, and then you get offered additional higher price services to go along with that. That's the business model. People who complain about having to pay for it, I don't know what they're talking about. Everybody's got to make a living. If you can get good financial advice for $50 or $70 or $80 a year, you're getting a pretty good deal. Now, a lot depends on the person making that or giving that advice and how they make a living, what kind of incentive structures they're facing. Now, in my time, when I was writing the newsletters, which I no longer do, of course, I felt that what I realized was that, in an ideal world, everybody would give financial advice according to the fiduciary rule, which is that everything that you say and recommend as a financial advisor is designed purely for the best interests of your client or your reader or your subscriber. Now, I always tried to do that. Didn't always get it right because, like anybody else, I make mistakes. I fell for some manias just like other people. I recommended a couple of SPACs that turned out to be rubbish, and which I think I certainly wasn't the only one to fall into that trap. Some of my much more famous and wealthy colleagues made similar calls and suffered similar fates. But there's always a temptation, particularly in financial publishing, to overstate the potential gains or the potential losses. The potential gains, when you're marketing a newsletter like the Bauman Letter or some of the other ones from Banyan Hill or indeed any other publishing house, the idea is to get you to buy the newsletter. And so you say, well, you could potentially make these big gains, but only if you buy this newsletter. And the problem is that if you overstate the case, you may get customers, but they won't be happy customers. The same thing goes for the fear trade. There are people who specialize in saying that, the world's about to fall apart. Joe Biden's going to take your money by converting it into digital dollars, all this kind of stuff. 99% of that stuff is rubbish. It's designed to scare people, particularly retirees, particularly older people, into giving over their money, for a secret that will protect them. And the secret tends to be pretty straightforward. Either you buy gold, or you buy bonds, or you buy, dividend-paying companies, whatever it is. But the bottom line is that the marketing tends to lead the action in the financial publishing industry. Now, I understand that. I worked in that industry for a decade. I like to think that I tried to navigate it with a clear sense of ethics. I believe that I did, and I'm not suggesting that my employer didn't. But I think that in general, you'll find that when you see a lot of financial publishing, it tends to be hyperbole, and that's because that's how you get people in the front door. Once you get them in the front door, of course, you have to keep them happy, which means that you have to have a reasonably good track record. And that's where the trend of the market comes in. Now, what has happened, I think, really during the period up till about 2019, and then again after the COVID crash of 2020, was that financial publishing was a very lucrative business to be in, because everybody could see that stocks were going up, right? And when you're in a rising market, all you've got to do is, exercise some very basic, stock picking techniques, and, look at the technicals, look at some underlying fundamentals. But the chances that you're going to be right are very, very good, because the market is rising. So the idea is you want to beat the market, but most people are happy even if you just beat it by a little bit. As long as you are beating the market, they feel like they're getting their money's worth. The problem is that when the market turns, your whole operation has been based on a rising market, a bull market, and all of a sudden you then have to figure out how to deliver financial advice in a falling market. You also have to figure out how to market your products to people in a falling market, and unfortunately that is extremely difficult to do. So what's happened in my former employer and other companies along those lines is that, like a big ship, trying to turn it around and adapt to a falling market and still offer good financial advice, I'll talk about that in a moment, it's a hard thing to do. And so the revenues go down. And so myself and some of my other colleagues left Banyan Hill. You've seen this in some other publishing houses as well. It's something that's happening all over the financial publishing industry. Now, the upside for me is that I can now say whatever I want within, boundaries. Of course, I have obligations to my ex-employer. I have obligations to YouTube. I have obligations to you. But I can talk about many different things that were simply not really on the cards or on the table when I was working for a financial publishing company. Now, the problem is that if you built your you built your business around a rising market, the market turns, you don't have the marketing, you don't have the products to deal with a down market. What do? Well, the problem is that people stop buying newsletters. That's what happened to Banyan. That's what happened to a lot of other companies. But unfortunately, that's a mistake because there are a lot of good people out there who can give you good advice even in a down market, and you shouldn't discount that. You should recognize that down markets are as much part of the investing scenario as up markets, and it's even more important to have good people who can give you good advice on what assets you should be holding in a down market, because that's when the stakes are much higher, right? Because you're looking for defensive assets, you're looking for counter trend assets, you're looking for non-correlated assets, and that sort of thing. Now, one of the things I have been doing in the last couple of months is looking at precisely those kind of non-correlated assets. And part of my next series of YouTube videos is going to be about non-correlated assets. I have some friends who, for example, a good friend in London who specializes in dealing in rare stamps and coins. And boy, that market has just been going great guns because people tend to put money into rare tangible assets like those at times of crisis, particularly in times of inflation, because they tend to beat inflation, and over long term they beat the stock market quite handily, and they tend not to pull back in value except in very short periods. That's the kind of thing that I think I can introduce you to. I can also introduce you to some other potential opportunities, like, for example, farmland. You ever thought about investing in farmland? It's one of the best asset classes out there, and you can in fact end up investing on a basically almost like a P2P loan type of basis. You invest along with other investors in farmland, and you can make really good returns, not just from the rental income you get from farmland, but also from price appreciation. And you can do it on a fractional basis. You don't have to buy a whole farm. You can invest 5,000, 10,000, whatever, and be part of a group of investors that, in a sense, hold bonds on farmland. So I've been researching these alternative investment classes, and at the same time, I've been doing a lot of work on my own portfolio, which tends to be full of dividend-paying companies, because I love dividends. And in fact, my personal portfolio has beat the market by a factor of 5 during 2022 because it is chock full of dividend payers. I reinvest those dividends so that they compound, which gives me a lot of protection against a falling market. And it also gives me inflation beating yields. All of the companies and funds and other things that I invest in have yields that are easily above inflation, sometimes 3, 4, 5, even 6% higher than the current inflation rate. And these are not dodgy companies. They're not, I'm not chasing yields. I'm looking carefully at funds and companies that can pay good yields. I know when to get into them and when to get out of them. And that's the kind of stuff that I'm going to be telling you about in my videos going forward. But on that score, I'd like to hear from you. And that's the main purpose of this video. I want you to put in the comments, what do you want me to talk about? What topics do you want me to address? I've mentioned non-correlated assets. I've mentioned rare tangible assets. I've mentioned all kinds of things that it should be possible for you to invest in as a counter-cyclical, non-correlated. That's what you want in a down market. We can also start talking about what to do as the market turns back up, because there will be some good opportunities there. All of those things I'm willing to explore and talk about in the videos, which I hope to publish every single week, barring a few holidays and that sort of thing. One thing I know I want to talk about pretty soon is FTX, Sam Bankman-Fried. Today, BlockFi, another big trading house, declared bankruptcy. Clearly, there is a big problem in the exchange side of the cryptoverse. And I'd like to talk about that because I have been talking about it for the last 4 or 5 years. I've been known as a crypto skeptic. I am to a large extent, simply because most of the crypto tokens have no inherent value. They don't provide any yield. And the only way that you can make money out of them is through quasi-Ponzi type arrangements. Now, what I really want to do is dissect what has happened at FTX so people understand clearly the difference between what's good in the cryptoverse and what's bad in the cryptoverse. So that's probably going to be my first video, which I'll address next week. Nevertheless, I would like to hear from you. What topics do you want me to address? I think there's a lot to be said. And remember, I'm doing this basically on my own accord. Nobody's paying me to do it. I'm doing it because a lot of people have said over the years that they like what I have to say. They like my honesty. They like the fact that I try not to be beholden to anyone. And now I really am not, because nobody's paying me to do this. I'm not employed. I'm doing it for you. So going forward, please let me know in the notes what you would like me to talk about, and I will do exactly that. Now, as I said, I'm going to try to put out 1 video a week. I'm still working on my own video production technique since I don't have a studio of producers to work with anymore. So bear with me if it looks a bit amateurish at the beginning, but over time I will develop my skills in that regard. Anyway, this is Ted Bauman signing off. I will be back next week with another video. Take care.